So you have a differentiated approach, very active, making portfolio decisions around allocation of capital. The clients who have known you the longest, how do they frame that and where do they allocate you within their portfolios?
One of our clients once described us as a macro investor that implements their themes through stock selection. And I think that's an interesting idea. The long-short manager has his or her head down in the grass, looking very close at the company, the management, and so forth. And the weakness of that is that when your head is down in the grass, you don't see the lawnmower coming in from left or right field, right? Now, the macro investor is focused on that all the time, right? They're looking at the big trends, where's the tsunami coming from. The problem for the macro investor is that there's only one or two key themes in the course of a year to get right or wrong. So your macro investor is either going to get it really right or they're going to get it really wrong. They can't diversify that risk away like you can when you are long or short 40 to 60 names. So a lot of this is about having a toolbox, whether it's company selection, whether it's macro thinking, that when the market presents you with different types of problems, you've got the tools to respond. And having a model that also allows you to be diversified enough so that when you're wrong, it's not the worst outcome.
One of the things clients tell me all the time is they want to give a manager flexibility. And of course, in this new active world, being able to go long and go short has a lot of advantage in a very volatile. How do you think about that to take advantage of these uncertainties, if you will, and risk, and what are the parameters that you might be long and short? And you've been running the strategy since 2002. Mm-hmm. Kind of, how has that unfolded in volatile times before?
Probably the most important point is to revisit why equities are a favorable asset class. Everyone understands that. That's what they're taught in school. They're a favorable asset class because when you take risk, you get more return. You are paid to take risk. And a lot of investors lose sight of that and they over-diversify and then they stop taking risk and then they wonder why there's no return. So equities as an asset class are very attractive. And the advantage of the long-short model and the ability to short is to take off some of those tails, volatile downside moments when it becomes very hard to believe in the long-term story for equities. And again, the long-short model gives us the flexibility to implement that. About 3/4 of our returns since 2002 has generated by the long side, perhaps 20%, a quarter by the short side. We tactically move our exposures on the long and short side, obviously depending upon our fundamental view. But more importantly, the short opportunity is cyclical. Mm-hmm. Okay, it's not always there. It was there in spades before 2008. But after 2008, you had the weak balance sheets thrown overboard, Bernie Madoff, other issues made very apparent. Why would you allocate the same resource to shorting in that environment as you did in the pre-2008 environment? So we're not simply sitting there all the time being short something.
Within your investment toolbox, you have both the flexibility to buy individual securities and ETFs. Talk to us a little bit how you implement your ideas through the portfolio.
Well, generally, we prefer company investments first because when you have a high conviction in fundamentals, it's a lot easier to stick with that over the long term. And the long term is where your real returns are achieved. But there are times when I think ETFs make a lot of sense. For example, we have a 2% long exposure in Vietnam. Now, I don't think it makes sense to buy 20 different Vietnamese stocks. It's a lot easier to buy a Vietnam ETF for that exposure. And in some cases, the countries limit foreign involvement, and therefore the ETF may be a preferred way of getting involved. But generally on the long side, we prefer direct investments. We use ETFs actively on the short side because it allows us to shift our exposures on a more tactical basis. Brexit happens and you say, well, I need to change my short exposure. If I turn to the analyst team and say I need 10 new short names, it could take a week or 2 weeks. So the advantage of the ETF is that you can move quickly to protect the portfolio.